Hello everyone, welcome to the Bowtie Breakdown. I'm Garry Morin, the Bowtie Guy, and this morning I am at Sierra Pacific Mortgage in North Providence with my friend Peter Nastasi.
Morning, Garry.
Good morning, Pete. Thanks for letting us stop by. Debt to income ratio, simply explained, it's basically the difference between what they make versus what they're spending out.
That's correct. It's as simple as that, and it's important to get it right because there's a lot of things that go into that, right? So you could have a borrower who is very simply a salary employee. They make, say, $50,000 a year. It's very easy to do their income, calculate their income. But if you have a borrower who has what we call variable income, meaning they're an hourly employee, but they may not consistently work 40 hours, and they may get overtime, they may get bonus, they may get commission. Well, now the income gets a little bit more difficult to structure.
Yep.
So we would want to get a verification of employment on that borrower to make sure when we are calculating this income, because now we're going to have to start averaging some income depending on the program that they go into. We'll have to really make sure we have that income nailed down, because when we give you that pre-qualification letter or pre-approval letter, whichever they've applied for, we want to make sure that the income is correct, because sometimes you have a client who is pushing that debt ratio to the limit. We want to make sure that we're confident in those numbers. We want to make sure we're confident in that pre-approval or pre-qual letter, and we want to make sure that that deal is going to go through smoothly and make sure that nobody's going to be disappointed at the end.
And essentially, the debt-to-income ratio is important because, the banks want to make money. They don't want to sit here and have to foreclose on the property.
That's, believe it or not,
because the person couldn't afford it.
Yes, believe it or not, it's a misconception, right? People think, oh, the bank just wants the house. That couldn't be further from the truth.
Right.
Banks and lending institutions do not want to own property.
Right. They don't want to deal with that mess.
We don't, because there's a lot of things that can happen. Vandalism, taking care of the
Theft.
property, theft. Yes, absolutely. So we want to make sure, and most, lenders want to make sure that a client actually qualifies for the loan, and that there's not going to be a problem after. There's things that are unforeseeable, unfortunately, but nobody knows that.
Right.
But, we want to make sure in most instances that people do qualify and they are comfortable with the payment, and they can make those payments for the foreseeable future, and it can be lifelong homeowners.
Yeah, and the ultimate goal for us is to get more referrals from that person. I could see if a person had got foreclosed on because they couldn't afford the property, how mad they would be at the lender, the realtor, or the person who put them into that type of situation. So that's important for us on our end, that we get it right so we get more referrals.
100%. At Sierra, we have internally we have these things called pillars, and basically what that is it's some principles that we have internally, right? We want to deliver, let's say, a wow experience. We want to do the right thing. We want to offer speed. There's some other things that we want to hold ourselves to a standard to, and one of those is a wow experience, right? We want to deliver a wow experience for not only the borrower, but for our referral partners. We want to make sure that the customer at the end of the day is 100% happy with the way their loan was handled, and we want them to know even when that's done, they can call us with questions, and we'll jump in and be happy to help them. And also, we want to give a wow experience to our referral partners.
Yeah, exactly. When I have a smooth transaction with a referral partner or somebody like that, I tend to want to work with that person again, as opposed to a bad experience. Just like the client, realtors and lenders work the same way. If we have a partner that wasn't a pleasant experience, we're probably not going to work together again.
Yes, 100%. It's Sierra is an independently owned company. It's been in business for almost 40 years.
Wow.
So it's a long-standing, stable company, and we survive off of referral business. So we're not in this for a quick dollar. We're in this to make sure our borrowers are happy, and our referral partners are happy, and customers are not being taken advantage of in any way, shape, or form.
There you go. That's Sierra Pacific Mortgage. Peter Nastasi telling us all about income to debt ratio. Sounds like a small thing, but it's a very important piece of the loan process. That was the Bowtie Breakdown. I'm Garry Morin. Thanks for watching. See you next time.